Hey again, guys. Tyler here with Seller Accountant, and we've been talking about this series, Freedom. How do we get more freedom for ourselves as entrepreneurs, as business owners? And we've acknowledged over the last couple of videos that anything we can do to increase our peace of mind, our time, the money we make in our business, anything we can do to decrease the bad news stuff over there, right? Risk, debt, stress. We've killed the boss because we're in business for ourselves. We're happy to be in control, but man, is it stressful to have all the burden of cash flow and everything else on your shoulders. So as the business owner, we've got to get smarter so we can make better decisions. We talked about using visibility to get smarter. Today, I want to talk about understanding your liquidity. Let me just propose to you that your level of stress right now, my level of stress right now, when it comes to, excuse me, coronavirus and everything else happening in the marketplace is going to be directly proportionate to your quick ratio. So I'm going to define what a quick ratio is for you. It's essentially your current liquid assets divided by your current due obligations or debt. And so the higher that number is, the more liquidity, the more cash you have in your business relative to your debt, the happier you are, the less stressed out you are about your debt. The lower that ratio is, the more stressed out you are, the more you're stressed about trying to get that next pay in from a receivable so you can turn on and pay it to your credit cards or to your other debtors. Let me show you a couple of examples to unpack how to actually calculate this. So here's, first of all, a happy example. This is the balance sheet. Again, quick ratio is the current assets. We do not include inventory in this calculation because inventory is not considered an immediate liquid asset. We're going to take that definition of current assets. We're going to divide it by our definition of current liability. So here's what it looks like for this particular seller. They have $123,000 plus some change of assets. By the way, if they had fixed assets like equipment or a patent that they were amortizing or depreciating a vehicle, that would be excluded. Those are your fixed assets. We're just talking about current assets. And so we're going to take that number, 123,000, and subtract our two inventory numbers. This guy has an inventory account and a prepaid inventory account. That leaves us with assets that are current and liquid of a little over $81,000 or just less than $82,000. Now, when we look at the liability side of this balance sheet, we have some accounts payable, we have some credit cards, don't have any sales tax collected that's due at this point at the end of this particular month. And we're going to exclude or ignore our long-term liabilities. So the debt that you have where you're just making small payments each month, you're going to count that as a long-term payment. We're going to talk about what we actually have to satisfy in the current month or the current couple of months. And so here's how you would calculate the quick ratio for the seller, right? My current total liquid assets divided by my current total liability outlays, and for this guy, the 81,000 divided by the 30,500 gives us a quick ratio of 2.68. What that tells us is that this business has a little over $2.50 in the bank for every dollar that needs to be spent to satisfy debt obligations in the near term. Now let's compare it with this other seller here. So this would be a poor example of a quick ratio. Same formula. I'm still going to calculate my assets by taking current assets, and I'm going to back out my inventory. In this situation, my total inventory when I take into my inventory and in transit is a little over 80,000. I'm going to pull that out, and so my liquidity is only $20,299. I've got about double that just in accounts payable. Thankfully, I don't have any other debt. But basically, I do the same ratio. My total current liquid assets of $20,299 divided by 46,665. And this particular seller has a quick ratio of 0.43. What this tells us is that we have less than 50 cents. In fact, we have 43 cents in our account for every dollar we need to pay in current debt. This is a scary situation. This is a seller who's feeling tremendous pressure and stress because of the way their business is set up. And I just happen to know these are both really smart business people. They're profitable on their P&L, but from a cash flow standpoint, this is a seller that needs an infusion of capital, or they need to restructure this accounts payable in order to continue to be viable. And it may be that they just bought up inventory for a rush that's going to come, and they were ready for this pinch, for this pain. But if I were in this situation, and some of you guys may be here, where my cash balances and current receivables aren't going to cover that accounts payable, aren't going to cover that sales tax payable, and those other small things that have to happen here soon, this is a great opportunity to go to your suppliers and see if you can renegotiate those terms to buy yourself some more time. This is a great time to try to get a loan where you can refinance this debt. Even a loan that I would say is not great debt, like an Amazon loan, may buy you 6 months where you can now turn this into a at least slightly longer term payment plan. But you have to be careful about this. You don't ever want to refinance debt or take on more debt to your business until you have carefully assessed your business model to ensure that you have a good business. You don't want to fund with debt a bad business. You only want to fund a business that has profitable products, that you're having to fuel growth through cash. And you want to always try to cut as many extra expenses as you can whenever you have to take extra debt. The goal is to turn a balance sheet like this, where there's very light assets outside of the inventory and very heavy debt. And you want to transform that balance sheet into one that looks like the first one we looked at, where we have plenty of assets on the balance sheet to cover our current liabilities. This puts us in a position where we're not going to feel the same level of stress when the market changes, and therefore our freedom goes up, because our peace of mind goes up. Our peace of mind goes up because we have lower debt, which means we're a lower risk profile. We're going to have lower stress. So I hope that's helpful. The whole purpose of this, again, is to try to help us think through how we can build more asset value in our business so that we don't have to be freaked out when things get a little bit tight. If this is you, by the way, and you're looking for ways to get your debt in control, I recommend a book called Profit First by Mike Michalowicz as a way, if you want to kind of think about your cash a little bit differently, that might be one worth reading. If you want help implementing something like Profit First, feel free to reach out to us at Seller Accountant. Hope you have a great day. Talk to you soon.